All right, welcome back to Channel 11. I'm Ken Shinoda, your host. Today is Monday, June 2nd. Let's take a look at what happened in May. It's a return to the land of gains. If you had just closed your eyes and gone on vacation, didn't check your Bloomberg on your phone, it's like nothing happened. Stocks are, I think, positive on the year now, and bond yields have, they're like the same as they were a year ago. We've had a sell-off recently, but rates have just kind of been in this big trading range for the last couple of years. So let's look at what's happening here. Is the market is now becoming a little less negative with the backing off of tariffs. You can see consumer confidence has flipped up a little bit. Business confidence slightly improving. Only home builder confidence continues to deteriorate, obviously with high rates, and we're seeing less activity in the housing market. GDP now has continued to tick higher after a decline due to that front loading of imports. And you can see some of this has to do with this the trade balance changing as well, leaking into GDP, Atlanta GDP now, and how it's calculated. So we got another weak manufacturing PMI print this morning, sub 50 in the negative zone, but services, which drives a lot of the economy, still in positive territory. And it's the shining light of the economy right now is that the consumer continues to spend. Prices paid, we've seen an uptick there. A little bit worrisome as inflation. We may have seen the lows in inflation, and we may go sideways now. But we've made good progress there. But I think given this potential risk, the Fed is probably on hold here, and we'll look at what the market's pricing a little bit later. Employment indices sub 50. This is also good for inflation in the sense that wages don't have as much pressure as they used to. But again, we may start going sideways and maybe see a little uptick. But we have to wait and see how the data comes through. All right, moving to equities, Mag 7, big drawdown, 30%. We've retraced a good deal amount of that now only down about 10% from the peak. And recent gains in the equity market over the last couple of days have been led by tech. Looking at market cap versus equal weight, with tech's rebound, that market cap weighted S&P 500 is doing better again. Looking at our speculation monitor, big, not a huge recovery, but a decent recovery across some of these things that got smoked. You can see ARK ETF has retraced about 50% of the decline. Even Dogecoin, little dead cat bounce, and Tesla also seeing some recovery. Some of that probably has to do with Elon coming back to work after being in his Doge zone for a while. All right, semiconductors, you can see a little comeback there too, but meaningfully off the high still. The big thought is there going to be this AI comeback? And we'll have to wait and watch. Chart doesn't look that great. You would think that this would have done similarly to other parts of the market that recovered. So still some weakness, I think, here in these semis. Looking at the Trump trades, small caps in the top left, I think, are going to struggle unless you can get rates to come down. That's, I think, one of the reasons that the small caps haven't caught up as much is because you've seen this rise in the 10-year on the right-hand side. Bottom left, financials, deregulation. That theme's kind of back in the equity market. You can almost a full recovery there in the bottom left. And then lastly, initially the Trump trade was strong dollar, but now I think the market thinks that the administration wants that to weaken that dollar. Now we've seen a pretty meaningful decline. We're at below the bottom end of the trading range, going back a couple of years. I wouldn't necessarily be shorting the dollar here. I think it's oversold, and we could see a recovery in the dollar. But I do think in the long run, having some non-dollar exposure is interesting. You can get that through equities, you can get that through currencies, and obviously that's why gold and Bitcoin have been doing so well, is people trying to find some diversification away from the dollar. Looking across sectors, year-to-date is in the blue. The Dow through last night still negative on the year, but really equities in Europe outperforming. The Euro Stoxx 600 up 10% year-to-date. Some of that obviously has to do with the currency. And big strong month for equities. Look at the NASDAQ up almost 10%. The Dow up 8%. S&P up 6%, Russell up 5%, but again, the Russell lagging because I think of that the higher rates out there. International equities had been the place to be and are making a comeback. You can see On the right hand side, it's really the euro equities that are doing the best. The yen has struggled a little bit there, and the Nikkei. And the bottom left, big comeback for emerging markets. One place that has continued to kind of lag developed markets. Valuations definitely look on the cheaper side if you're looking at PE ratios. Morgan Stanley just came out over the weekend saying there could be I think they called it like a frightening rally. Basically, people are underweight, and they think that might be a place to look for opportunities. So let's keep our eyes out on that EM market. Make Europe Great Again was working in a big way, but we've seen U.S. equities make a big comeback, especially the tech. We have more tech in our indices than if you look at Europe. So I think we've seen that big comeback in tech, and Europe is kind of lagging. It's kind of going sideways. So they're not really lagging. They're just kind of even right now. Dollar, we looked at that. We just looked at that bottom end of that trading range. Again, probably not the best place to be shorting the dollar here. I think we might see a little bit of bounce. So if you're looking to get some non-dollar exposure, you might get a better entry point if the dollar gets stronger to exchange those dollars and buy into those international equities. Amazing how this looked just like the last administration. We've been following this, and it's almost following it exactly. It's amazing. But like I said, I do think that there's some potential more strength for non-dollar currencies. But right this second, we are at the bottom end of the trading range on the Dixie. Same with the yen. We're at the bottom end of that trading range. It's hard to have huge conviction to be buying yen here. Commodity index kind of going sideways. It's struggled to break out of this kind of trading range it's been since 2023. But as we look at it, it's really a story of precious metals. It's most of the gains in commodities have been in gold, precious metals, silver, and copper as there's been some talk of re-stimulus in China. But oil really dragging down 11% for crude oil and Brent crude, with OPEC talking about pumping more oil. So don't see potential upside in energy, just given not only is OPEC talking about that, but the current administration's drill baby drill mentality as well. All right, rates. We've seen a backup in rates. We saw the 30-year get up to almost the highs of 2023. Not quite there. I think the high in 2023, October of 23, was like 517 on the long bond, and I think we got to 512, and we held that in. A lot of negative articles and whatnot about the long bond, obviously, when we get to the highs. So I don't know. I think we might have seen that retest of that highs and potentially hold that 515 level. Haven't really seen big buying coming in. Usually you get this big buying at certain levels, like 5% is usually a big psychological number, but we just haven't seen huge demand come in. A lot of managers, including ourselves, rather be in that 2-5 and maybe even 10-year portion than rather than go out all the way to the long bond. So interesting chart I saw. More the sellers in the red line of homes versus buyers. Obviously, buyers are near an all-time low because rates are high, and they're frustrated because prices are high, and rates feel like they're coming down, and they go up again. And it's got to be a rough time to be a buyer of housing market just because it's the competition's high. But the good news is there's more sellers, so supply is coming back on the market. We're still, we're basically going back to like normalized levels of selling, which you can see was pre-COVID, 2019. And so I don't think this means the housing market is going to crash, but I think it could soften. The Case-Shiller numbers that came in for 2 months ago, because there's the data is with a lag, went down for the first time in a long time. I think we were down like 0.3% or something, which I know isn't a lot, but it's just a sign that there's maybe some more supply of housing coming. So that's good news for you would-be buyers out there. Treasury yield curve continues to steepen. We've had a 230 steepener on in some of our strategies, and that's did nothing for a while in 24, and then all of a sudden started to work. Keep that on. And let's look at fixed income performance. So this is the month of May with the rate back up, the high quality stuff that's longer duration, the bottom left, doing poorly. Treasuries, agency mortgages down about 1%. The index down about 0.7 because it owns corporate bonds, which have done well. Even though rates have risen, spreads have tightened. So you got an amazing 0% return, which is better than negative. And really what's working is the risky credit that's floating rate that had lagged is playing catch up now. So credit, yet again, seems to be the place to be as we look year to date. A lot of the credit sectors, especially the securitized sectors, 3-4% type returns there. But also year to date, agency mortgages hanging in there too, up 3+%. And levered loans, depending on the risk, you can see the CCC levered loans doing the best, up 370, high yield up about 270. So, fixed income basically earning its coupon. We're about 6 months through the year. Core plus bond portfolio has probably yielded about 5.5% or so to 6% going into the year, and they're basically earning their carry here. Credit performance here today, everything in the blue. I guess the blue means green here. If I showed you this chart in mid-April, a lot of this was in the red. If I showed you this a week or two ago, everything was positive returns except for CCC high yield, which is now flipped positive with the chase for yield here. It's funny because these bars make it look like the return is really high, but it's like a relative thing. The best return is those CCC rated bank loans, up 3.7%. All right, what's the market thinking about the Fed? Well, it's funny, through the end of December, the blue line is what the market's saying now. The red line was at the beginning of the year. They're kind of ending up almost at the same place. It's just that to the start of the year, the market thought that the Fed would start cutting much sooner. And here we can see that the market's now thinking that we're not going to do anything till kind of the end of summer. And depending on how the data comes out, they may do nothing this year. We'll have to wait and see. But right now the market's thinking they're cutting about like 1.5 times. Inflation expectations, let's look at the left-hand side. Those are break-even inflation expectations. You can see that spike up of the 2-year break-evens or short-term inflation that had to do with the worries about the tariffs. And as the tariffs get backed off, that short-term inflation expectations have come back down. Spreads, what have spreads done? Kind of a weird chart, bottom left, but bear with me. The blue is what's happened from the end of last month. So we basically saw a bunch of spread widening, and then we saw spreads are coming in as equities have gone up and the credit markets are recovering. High yield in 70 basis points, and it had already started to rally. And so now you can see the change from the end of the year. That's the gray charts. So spreads are still a little bit wider than they were to start the year. So there's definitely room for some more spread compression. Triple B CMBS is actually tighter because it kind of lagged last year. And so on the right-hand side, you can kind of see where spreads are. You can still get high-quality securitized assets about 100 to 150 over Treasuries, which we think is a safe place to be. And high yield has come in a lot. It's now, as of April, this is as of April 30th. It's actually tighter than this now. But, it's been a big rally in credit as well. So here you can see that rally. On the left-hand side is investment grade option adjusted spread. Got all the way out to about 120. And now here we're in the high 80s. We got as tight as around 75. So about 12, 13 basis points from the tights earlier this year. And then high yield, low 300s, got all the way out to about 470. And here we are at 315. The tight was almost 250. Equities back basically to where they were, looking kind of expensive, and credit spreads on the corporate side not looking too cheap either. They got cheap. They never got as cheap as they were in 23. It was like one of those things where spreads were definitely wider than the start of the year, but we weren't in like the screaming cheap buy zone ever. I think fixed income markets held up pretty well because we didn't see any forced selling. There was really no forced selling out of bond funds. We saw some selling in kind of these big ETFs by macro players, knee-jerk, stocks down, sell HYG, but we never really saw a lot of forced selling, at least as we saw it in the credit market. So here's that what's cheap report that we love to look at. And IG at one point got all the way up to about 40th percentile. That's back down to 9th percentile. High yield at one point was all the way down at like 1st percentile, got all the way up to about 60th. And here we are today with high yield at 16th percentile. That Spread of 315, average spread going back 10 years 411. Agency mortgages still looking cheap. It's one of those places where the spread is cheap and it's really a carry trade because the technicals are still challenging with the banks buying, but not buying as much as they used to. The Fed out of the market, so it's a good place for carry, but I wouldn't say that you're going to see some knee-jerk retracement there, but we do think it has compelling relative value to corporates. Securitized credit sectors are playing catch-up with corporates. They were all further up this chart last month, and they're starting to make their way down, and we see some decent demand there, and the fears of April have gone away for now. So we're heading into the summer. Hope everyone has a great summer. We'll probably take July and August off, and we'll catch you next time. Thanks.